Michael is 34 years old, and for the last 6 years he has wanted to start investing. Every few months he opens his laptop late at night when the house is quiet and types, "How to invest in ETFs" into YouTube. 20 minutes later, he's more lost than when he started. One video tells him to buy this fund. Another says that fund is a mistake. A third insists everyone else is doing it wrong. Michael closes the laptop, and somewhere underneath the confusion sits a quieter fear he's never said out loud. What if I lose everything the moment I finally try? So he waits. 6 years of waiting. 6 years of watching his savings sit still while life gets more expensive around him. If any part of that feels familiar, you are not behind, and you are not alone. Today, that ends. By the time this documentary is over, you will understand ETFs more clearly than most people who've been investing for years. Not because you'll memorize complicated terms, but because you'll actually understand what's happening underneath them. So let's slow everything down and start from the very beginning, the way Michael eventually did. Before we even talk about ETFs, we need to understand the difference between saving and investing, because most people quietly confuse the two without realizing it. Saving means putting money aside and keeping it safe, usually in a bank account. It doesn't grow much, but it also doesn't lose value overnight. Investing means putting your money into something with the goal of growing it over time, accepting that its value can move up and down along the way. Saving protects money. Investing grows money. You need both, and understanding why is where real confidence begins. Here's something almost nobody stops to think about. Money quietly loses value every single year, even while it sits untouched and safe in a savings account. This is called inflation. It simply means prices for everyday things like food, gas, and rent tend to rise over time, so the same dollar buys a little less next year than it does today. This isn't a flaw in the system. It's just something every saver eventually has to plan around, and it's the entire reason investing exists as an idea in the first place. If your money isn't growing at all, it's quietly losing ground every year, even though the number on the screen never changes. For most of history, growing your money meant picking individual stocks, one company at a time, researching each one, hoping you picked the right one. That's slow, it's stressful, and even professional investors get it wrong constantly. So decades ago, a simple but powerful idea emerged. What if, instead of buying one company and hoping it succeeds, you could buy a small slice of hundreds of companies in a single purchase? That idea became the ETF, and it's the exact idea that eventually gave Michael his way in. ETF stands for Exchange Traded Fund. Break that phrase apart, and the whole concept becomes almost obvious. Fund means a basket, a collection of investments bundled together. Exchange traded means that basket can be bought and sold on a stock exchange, the same place stocks trade, at any point during the day, just as easily as buying one share of a company. So an ETF is simply a basket of investments, like stocks or bonds, that you can buy or sell as easily as buying a single share. Picture walking into a grocery store. Instead of buying one single apple and hoping it's good, you buy a pre-made fruit basket, apples, oranges, bananas, grapes, all in one box for one price. If one type of fruit isn't great that week, it doesn't ruin the whole basket because you have variety working in your favor. That's essentially what an ETF does with companies. Instead of buying stock in one single business and hoping it performs, you buy one ETF, and instantly you own a small piece of many companies at once. This is exactly why the fear of picking the wrong one starts to fade once you understand ETFs. You're not staking everything on a single guess anymore. When you buy a share of an ETF, you don't own the individual companies directly. You own a share of the fund itself, and the fund holds all those individual investments on your behalf. The value of your ETF share rises and falls based on the combined performance of everything inside that basket. This single idea, buying diversified baskets instead of individual companies, is exactly why ETFs became one of the most widely used tools for everyday investors, and why so many beginners searching for ETF investing and index fund investing keep landing here, at the same starting point. I'm John, and if you're enjoying documentaries that simplify investing, personal finance, wealth building, and money psychology into practical lessons anyone can understand. Subscribe to John Explains Money. Every week, I publish documentaries designed to help you become more confident with money and avoid expensive financial mistakes. Now let's continue. Before you ever buy your first ETF, there's something even more important to understand first. Not all ETFs are built the same way, and knowing the difference is what turns confusion into clarity. Broad market ETFs try to hold a little bit of almost everything available in a market, giving extremely wide diversification in a single purchase. Some ETFs focus specifically on large, well-established companies that make up a major stock market index, giving you exposure to some of the biggest businesses in the country all at once. Total market ETFs go even further, attempting to include companies of every size, from the largest to the smallest, inside one fund. International ETFs shift your focus outside your home country, letting you invest in businesses based elsewhere in the world, adding a different layer of diversification. Bond ETFs work differently. Instead of holding pieces of companies, they hold debt, essentially loans made to governments or corporations, which tend to move more steadily but usually grow more slowly than stock-based ETFs. Dividend ETFs focus on companies that regularly share a portion of their profits with investors as cash payments. Growth ETFs lean toward companies expected to expand quickly, while value ETFs lean toward companies that appear underpriced relative to what they're actually worth. Sector ETFs narrow their focus onto a single industry, like technology or healthcare, which can mean more potential but also more risk, since you're less diversified. Real estate ETFs give you exposure to property-related investments without ever buying a building yourself. Commodity ETFs track things like gold or oil, and actively managed ETFs are run by a manager, making ongoing decisions about what to buy and sell, rather than simply tracking a fixed list of holdings. You'll often hear ETFs mentioned in the same breath as mutual funds, so let's clear that up too. Mutual funds are also baskets of investments, but traditionally, you can only buy or sell them once a day after the market closes at one fixed price. ETFs trade throughout the day on an exchange, the same way stocks do, with prices shifting as the market moves. ETFs also tend to carry lower ongoing costs than many mutual funds, though this varies fund to fund. And how does an ETF differ from simply buying one stock? A single stock ties your money to one company's fortune. An ETF spreads that same money across many companies, so no single company's bad day sinks your entire investment. As for index funds, many ETFs are actually a type of index fund, meaning they're built to track and mirror a specific market index rather than try to beat it. This is exactly why so many beginners are pointed toward diversified, broad market ETFs first. They're simple, low cost, and instantly diversified, which quietly removes most of the guesswork that scares new investors away before they even start. Now let's talk about how ETFs actually make you money, because this is usually the moment everything clicks for beginners. There are two main ways. The first is capital appreciation, which simply means the value of what you own increases over time. So if you eventually sell, you sell for more than you paid. The second is dividends, cash payments some companies make to investors, distributed to you through the ETF that holds them. Many investors choose to reinvest those dividends, using them to automatically buy more shares instead of taking the cash, letting the investment grow on top of itself. This is called compound growth, and it might be the single most important idea in this entire documentary. Compound growth means your money doesn't just grow, it grows on top of what it already grew. Picture a snowball rolling down a snowy hill. At the top, it's small, but as it rolls, it picks up more snow, and because it's bigger, it picks up snow even faster, building on itself with every turn. Your investments can work the same way. Growth from one year can generate further growth the next year, and given enough time, that snowball effect becomes genuinely powerful. This is exactly why time matters so much in investing. It was never about timing the market perfectly. It's about giving your money as many years as possible to let that snowball roll. This is also the part that quietly answers one of Michael's oldest fears. What if I'm already too old to start? Compound growth rewards time, yes, but it doesn't require youth. It simply rewards starting and then staying, invested from wherever you are right now. The best time to start was years ago. The second best time is today. This brings us to diversification, a word you'll hear constantly in investing, and one worth truly understanding rather than just repeating. Diversification simply means spreading your money across many different investments instead of concentrating it in just one or two. Why does this matter so much? Because if you only own one company and something goes wrong there, your investment can suffer badly. But if you own small pieces of hundreds of companies through an ETF, one company struggling has a far smaller effect on your overall investment because it's just one piece of a much larger basket. Diversification doesn't eliminate risk, but it meaningfully softens the impact of any single point of failure. And that word, risk, deserves an honest, clear explanation because fear of risk is exactly what kept Michael frozen for 6 years. Risk simply means the value of your investment can go down as well as up. It isn't a flaw hidden in the fine print. It's a basic, permanent feature of investing that every investor, no matter how experienced, has already accepted. There's a version of this fear almost everyone carries quietly. What if I start investing and the market crashes tomorrow? It's worth naming honestly because it can happen. Markets do fall, but understanding the different shapes that risk can take is what turns that fear into something manageable instead of paralyzing. Market crashes are sudden, sharp drops in value across the market. Bear markets describe longer stretches where prices decline over time. Corrections are smaller, shorter pullbacks that happen fairly often, even in otherwise healthy markets. Volatility simply describes how much prices swing up and down. Inflation risk means your money could grow slower than the rising cost of living. Interest rate risk affects certain investments, especially bonds, when interest rates shift. Currency risk applies when your investments are tied to other countries and currency values move. Sector risk applies when you're heavily invested in one specific industry. And concentration risk applies whenever your money isn't spread out enough. No investment, including ETFs, is free of risk, and no investment can ever guarantee a specific return. Anyone who promises guaranteed profits anywhere online is not telling you the truth. So if there's no guarantee, why do millions of people still invest in ETFs anyway? Because historically, over long stretches of time, broad markets have tended to recover from downturns and grow overall, even though the path has never once been smooth. Investors accept short-term uncertainty in exchange for long-term potential, understanding that patience is part of the deal, not an optional extra. There's one mistake that quietly destroys more beginner investors than almost anything else, and it isn't a bad ETF. It's reacting emotionally to normal, expected movement. We'll come back to that. But first, an honest question worth asking before you invest a single dollar. Is this even the right moment for you? This means ETFs aren't automatically right for everyone in every season of life. If you're carrying high-interest debt, have no emergency savings, or might need this exact money within the next few months, investing may not make sense yet, because investments can lose value in the short term, and you never want to be forced to sell at a bad moment out of pure necessity. That answers another quiet fear beginners carry. What if I need this money sooner than I expected? The honest answer is simple. Only invest money you're comfortable leaving alone for years. Everything else belongs in savings, not in the market. Which brings us to a question almost every beginner asks, including Michael. How much should I invest? There's no single number that fits everyone, and anyone online claiming otherwise is oversimplifying to sound confident. What matters far more than the amount is consistency, investing steadily over time, rather than throwing in a huge lump sum out of urgency or fear of missing out. Here's something worth hearing clearly. If you only have a small amount to start with, ETFs were never only for the wealthy. Many can be purchased for the price of a single share, which means starting small is not a lesser way to begin. It's simply the beginning. Before investing anything, most educators agree on the same foundation. Build an emergency fund first, money set aside for unexpected expenses, so you're never forced to sell investments during a personal emergency. Only invest money you can genuinely afford to have tied up for years, And take time to understand your own risk tolerance, meaning how comfortable you personally are watching your investment's value move up and down, because that comfort level is deeply personal, and it shapes which choices actually make sense for you specifically. Preparing to invest also means being honest with yourself about the bigger picture. What are your actual goals, and over what time frame? Do you already have emergency savings in place? Do you carry high-interest debt that might be worth addressing first, since guaranteed debt reduction can sometimes outweigh uncertain investment growth? These aren't questions with one universal answer. They're questions worth sitting with honestly before you begin, the same way Michael eventually sat with them. Once you feel ready, the next step is opening a brokerage account, simply the type of account that allows you to buy and sell investments like ETFs. In the United States, opening one typically requires verifying your identity, usually through a form of government identification, along with your Social Security number or tax identification number, since brokerages are legally required to confirm who you are. You'll also typically provide bank account information to fund the account, along with proof of your address. Exact requirements can vary slightly from one brokerage to another, so it's worth checking directly with whichever company you're considering. A brokerage account itself doesn't invest your money automatically. It simply gives you the platform to do so. Once it's funded, you choose what to buy, including ETFs. You may also come across retirement-specific accounts alongside regular brokerage accounts. In the U.S., a 401k is typically offered through an employer, often with contributions taken directly from your paycheck. A traditional IRA and a Roth IRA are both individual retirement accounts. You can open yourself, each with different rules about when taxes apply. One generally taxing money when it's withdrawn in retirement, the other generally taxing money before it goes in, so withdrawals in retirement can potentially be tax-free. This documentary won't give you specific tax advice, since everyone's situation is different. But knowing these account types exist, and that they interact with ETFs differently, is an important piece of the foundation. Once your account is open and funded, buying an ETF is refreshingly simple. You search for it by name or ticker symbol, decide how many shares or how much money you want to invest, and place an order, not unlike checking out on any online store. But before you buy, it helps enormously to know how to actually read what you're looking at, because every ETF has an information page, and that page tells you almost everything you need to know before committing a single dollar. Start with the investment objective, a short description of what the fund is actually trying to achieve, whether that's tracking a broad market, focusing on a specific sector, or something else entirely. Check the expense ratio, a small ongoing fee expressed as a percentage, which quietly affects your returns year after year, so generally, lower is more efficient. Look at the holdings, the actual list of what the fund owns underneath the surface, so you know exactly what you'd be buying into. Consider the diversification, how spread out those holdings actually are. Note the assets under management, essentially how much total money is invested in that fund, which can hint at how established and widely used it is. And finally, check its liquidity, how easily it can be bought and sold without causing unusual price disruption. None of this requires being a finance expert. It just requires slowing down and reading before you click buy, instead of buying because a headline told you to. This brings us to the mistakes that quietly damage beginner investors far more often than any market crash ever does. Panic selling, pulling money out the moment values drop, often locking in a loss that would have recovered with patience. Buying something purely because it's trending on social media, without understanding what it actually is. Chasing quick riches instead of steady long-term growth. Trying to time the market perfectly, buying only at the best moment, something even professionals consistently struggle to do. Checking your investments every single day, which tends to fuel anxiety far more than good decisions. Ignoring fees, which quietly compound against you the same way growth compounds for you. Following hype instead of a plan. And investing without any clear goal at all, simply because it feels like something you're supposed to do. It's worth being completely honest here. Investing through ETFs was never a get-rich-quick system, and treating it like one is where most disappointment comes from. This is slow, patient, unglamorous growth measured in years, not days. The people who benefit most from ETFs aren't the ones checking prices every hour. They're the ones who set a plan, stay consistent, and let time do the quiet work in the background while they live their lives. Underneath almost every one of these mistakes sits psychology, not math. Fear convinces people to sell at the worst possible moment, turning a temporary dip into a permanent loss. Greed convinces people to take on risks they don't fully understand, chasing bigger and faster gains. FOMO, the fear of missing out, convinces people to jump into something simply because everyone else online seems to be doing it, even when it doesn't fit their own plan. The investors who tend to do well over time aren't the smartest people in the room. They're the ones who practice patience, staying invested through discomfort instead of reacting to it. Discipline, sticking to a plan even when it feels boring. Consistency, showing up with the same steady approach month after month, whether the market is exciting or quiet. And delayed gratification, accepting smaller, steadier progress now in exchange for meaningfully greater results years down the road. None of these are personality traits you're born with. They're habits, and like any habit, they get easier the moment you understand why they matter. This is also why ETFs are typically thought of as long-term investments, generally held for years, sometimes decades, rather than days or weeks. Short-term price swings are simply part of the experience, and they tend to matter far less the longer your money stays invested. When markets fall, and at some point they will, emotionally disciplined investors remind themselves that downturns have historically been temporary chapters within a much longer story, not the ending. They resist the urge to panic because selling during a downturn is what turns a temporary paper loss into a permanent, real one. One more piece beginners rarely think about is naming a beneficiary on your investment accounts, simply the person you designate to receive your investments if something happens to you. It takes a few minutes, and it ensures your investments can transfer smoothly to the people you care about, rather than becoming complicated later when it matters most. And what about all the conflicting advice online? The exact thing that used to stop Michael before he even started. Once you understand the fundamentals covered here, that noise loses most of its power. You stop needing someone else to hand you the right answer, because you finally have enough understanding to filter the noise yourself. Which brings us to a few final myths worth clearing up for good. Myth: ETFs are only for wealthy people. In reality, many can be purchased for the price of a single share. Myth: ETFs guarantee profit. No investment can honestly promise that, and anyone claiming otherwise shouldn't be trusted with your money. Myth: you need to be a financial expert to invest. You need understanding, patience, and a plan, not a finance degree. And myth: you have to find the perfect ETF to succeed. In reality, understanding what you own and staying consistent matters far more than chasing perfection. Michael eventually opened his own brokerage account, not because he suddenly became an expert overnight, but because he finally understood the basics well enough to stop feeling paralyzed by them. He knew what a diversified ETF actually was, and what he'd actually own inside one. He understood that risk was normal, not a warning sign to run from. He built his emergency fund first. He chose an amount he could invest consistently, even though it was small at the start. He stopped checking his account every day, and for the first time in 6 years, he stopped waiting for someone online to hand him the right answer, because he finally had enough understanding to make his own. That's really what this entire documentary has been about. Not telling you which ETF to buy, because that was never the goal, and no one honest would ever promise you that. The goal was helping you finally see what's actually happening underneath all the noise, so that from here on you can move forward with clarity instead of fear, patience instead of panic, and a plan instead of a guess. Successful investing is not about finding the perfect investment. It's about understanding what you own, managing risk wisely, staying patient, and giving time the opportunity to work in your favor.